Hello, this is Mike Wade and welcome to this video featuring Tom's Tools and yours truly. Stock and options trading has large potential rewards but also large potential risk. You must be aware of these risks and be willing to accept them in order to invest in the stock and options market. Don't trade money you can't afford to lose. And you know I am not an investment advisor. Please don't construe anything I'm about to share as advice. All prices are in US dollars unless noted otherwise. Please feel free to read the balance of the disclaimer at your leisure. All right, I got a question for you. Would you be interested in this? If I was to tell you with a click of a mouse, you could receive stocks in a bullish or bearish pattern along with a really cool option trade, in this case a spread. Would you be interested in that? Click a button, get a trade. Well, of course you would, and what I'm going to call this is stock and trade selection, done for you, DFY. That's what we're up to in this video. We're going to do so with Tom's vertical spread ranker. We're going to talk about vertical spread basics, what's a long call spread, what's a long put spread. We're going to find these done-for-you vertical spreads using the ranker, and I'm going to show you how to manage these spreads once you get in, both entry and exit rules. So long calls are constructed as follows. What you do is you buy a lower strike call. Let's say we're going to do, as an example, an XYZ 100 call. Hypothetically, that call costs us 10 bucks. And then we're going to sell a higher strike call for $6, a 120 for $6. So we're going to spend 10, we're going to get 6 in, and that's going to reduce our total cost of the trade, the long call spread, in other words, down to $4. All right, so that's how we do it. That's a long call spread. Those two legs are considered the same trade. So in other words, what happens is you put these two orders in together, these two legs in together, and that constitutes what's called a 100, 120 long call spread for $4. So to get into these things, there's some basic entry rules. These rules coincide with the vertical spread ranker. You want to buy an at the money call or slightly in the money call, sell the higher strike call, which will be out of the money, and then use 15 to 45 day options, and then get out before the earnings announcement in case the news is not as expected and the stock tanks, potentially leaving you at maximum risk. And then to exit these things, if you double your money, consider getting out, or getting out a half for a risk-free trade and taking the balance to expiration, for example. Maybe if you get a 50% loss, you should get out too. That's a good rule. If your calls are in the money at expiration, just let the whole thing expire. You'll be assigned and you'll get maximum profit. So if both calls are in the money, which means the stock is above both short strikes, let the whole thing expire worthless for maximum profit. Now, if the stock is between the strikes at expiration, then you want to close the spread, and that involves doing exactly the opposite of what you did to get in. So that's the basics. Let's do some searching, hopping into the software. Let me show you where you can find these things. Find this wonderful ranker. You go to Searchers, Single Strategy, and Vertical Spreads. All right. Simple scanner. First off, note that you can do call spreads or put spreads. All right, so bullish or bearish. I am back tested 1 year from today's recording. It's now the 3/29/2019. I'm back testing 1 year. You want to back test everything you do with Tom's Tools, so that's what I'm doing. I'm demonstrating that for you. And then the rest of it you can just leave alone. All right, so there is a stock list that's been generated with ideal call spread candidates in terms of slippage and open interest and volume. Those things are considered in generating a nice call spread stock list. And then you've got the expiration dates. Leave those alone. Those match up with what I just shared with you. This is one of the cool parts. This part allows for the scanner to go out and find bullish opportunities for you using the 10, 16-day simple moving average cross. So it's going to detect for you the stocks that have, within the last 3 days, had a 10-16 bullish cross and only present those to you. So everything that comes up on the list will be a bullish opportunity according to the 10-16 moving average crossover system. So again, really all there is to do is click the search button, which I'll do. Doesn't take very long. We get through this list. I think there's around 300 stocks or so in the list. And then when it comes back, you see a very interesting list of different companies and stocks and charts. You can see the 10-16 day moving average cross. If I pull that up, You can see there that it's tough to see, but there is a 10-16 bullish cross. You can look at the 200-day moving average, the darknet chart if you choose to. It's got the closing price. It's got the strikes that are being used. We're buying a lower strike call at 46.50 and selling a higher strike 48. And we're using April options. This is a vertical spread. 2 different strike prices in the same month. We've got the actual quotes for each of the legs, the cost per contract, and the maximum profit. And then the most important column on here is this one, stock percent to double for the spread. This is going to rank the spread so that the positions that double with the smallest movement in the stock price are on the top. So this one, for example, on Halliburton will double with a 2.09% move in the stock. Think about that. The stock goes up 2%, just over, and you double your money in your spread. Welcome to the power of options. So just as an example, let's hop into Halliburton, and I've already got a risk graph up here. So this is Halliburton. I position sized it to 7. So I want to do 7 of these so I can keep my risk at around $500. So the cost of this trade is $497, and that it corresponds with the maximum risk. The maximum profit in the trade is also calculated for you. That's at expiration typically. And of course I've got the price per one contract, and that, which is $71. Multiply that by 7 and you get $497. So price per one contract, price for the position, which happens to be 7 contracts. So there's your risk graph in modern view. You can see here stock goes up just a little bit, doesn't have to go up but 2%, and you're looking at some nice profit in the neighborhood of $400 with a small move up in the stock. So really, for us to get our 100%, 111% profit, which is right here, you know, it doesn't take much of a move in the stock. So that's the spread. Follow the rules to get out of it. What happened in this particular case is the stock took off, and then at expiration, both the short call here at 48, let's make sure of that, 48, and the 46.50 long call, both of them were in the money. The stock price was up here where the blue line is. Both of these options were in the money. We let the whole thing expire for maximum profit to the tune of 111% plus. All right, just as summary, this is what we did. We went into the vertical spread ranker, and although I could have selected a few of these settings and altered them, I didn't. Really, I just popped into the vertical spread ranker, clicked search, and then I started moving down through the list because they're sorted by the positions that double their money with the smallest move up in the stock price. You can do the same thing with put spreads. The construction's just the opposite, but really the same thing, but upside down. And I hope you found this video interesting. I highly recommend you go back and back test it and get into the world, the magical world of vertical spreads. Thanks for watching, and I'll see you next time.